Hello, today is August 8, 2011, and thank you for checking out this video update. I don't like to normally put my face on these. I prefer to do the screen capture video variety, but today was kind of an unusual day, so I thought it might be best just to speak like this rather than show charts and things of that nature. For those who don't know, today was one of the worst days in the market in the last 4 years. In fact, I think I'm looking at notes on my screen below here, but Dow was down 634.76 points. The S&P 500 was down nearly 80 points, which is a drop of 6.6 or almost 6.7% for the day. That pushes the S&P now down about 11% year to date. But really, that's just sort of part of the story because a lot of investors, they have more than just large company stocks in their portfolio. So if you also have a well-balanced or diversified portfolio, the irony of that is right now that's dragging your returns back a little bit. Medium-sized or mid-cap stocks are down about 14.6% now year to date. Small-cap stocks down over 17% year to date. International stocks that are in developed nations are down 15, and emerging markets are down 19.2% year to date. So kind of what we're looking at now is after the big declines of the last week or so, really this decline has been going on since the market kind of hit a peak. Looks like around the first week, towards the end of the first week in July. At which point the S&P and all these other stock indices were up anywhere from 3 to 12% for the year. From that point now, obviously, they've dropped so much that the decline for some of them is now over 20%, which is typically one of the ways people will validate a bear market. So they'll say that a bear market is when from a market's high to its current value, there's been a decline of 20% or more. And then a bull market is the opposite, the first 20% after that's happened, sort of recovery. Interestingly, we only a few years ago were in a bear market, and that bear market lasted for over a year, almost a year and a half actually. So when we look at the short amount of respite, given where the market is today, just again give further perspective now on a 2-year basis. So if we go back 2 years from today, we'll go and move this to a 1 year. Excuse me here. So on a 2-year basis, the market is actually about flat. So for over the last 2 years, up a little bit on mid-cap and small-cap stocks. And if we go back 3 years from today, towards the end of 2008 or August of 2008, every single one of these benchmarks is down pretty substantially. And so when we look at kind of where the market is compared to what it was 3 years ago, it's down again quite a bit. 5 years, we get the same story. Virtually everything is negative. And if we go back 10 years, again, S&P 500 is down about 8% cumulatively over the last 10 years. So it's been a pretty rough beat for investors. We understand that. And most people, what they really want to know is kind of why this happened and then what's going to happen going forward. Well, the big reason why it happened is that the U.S. economy, which has been reliant a lot on government spending, or in the case of what's happened recently, was what was referred to as quantitative easing running out. So there was a certain amount of money that our government was issuing. In reality, would be the Treasury was issuing, and was Federal Reserve issuing to buy Treasury bills from our government. Boy, if that's not confusing, I don't know what is. And that ran out, I believe it was either June 30 or July 31st, so just in the last month or two. And from that point now, we have recently gone through a bit of gridlock over a U.S. debt ceiling. So basically what was happening is our national debt was rising pretty significantly the last few years. That was due to the fact that our budget each year seems to be $1 trillion or two under what, over what our actual tax revenue is. So because the debt ceiling was raised, some people thought that might let the markets go, but really it did the opposite. And I think a gentleman named Peter Schiff had a really nice analogy on kind of why that happens. And his was, if you're overweight, your diet can't be to eat more. Your diet should be to eat less and perhaps exercise some. But unfortunately, that's what's been happening here in the United States. We've been getting more and more and more debt, and then the solution was let's allow ourselves to have more debt. And I think because of that, it set up a chain reaction of sorts. One of the first things that happened was Standard & Poor's downgraded U.S. government debt. We used to be sort of the gold standard, if you will, globally, and we had a AAA rating. They moved it to AA+, and then even made some comments that they may reduce that further. They then over the weekend downgraded Ginnie Mae, which is a government entity, if you will. I guess it's an independent company subsidized by the government, and perhaps even today run by the government, since it defaulted, ran into massive financial problems, we'll call it, back in 2008. So when we think about what happened also over the weekend, some other news for those who weren't following this, I believe it was the finance minister of China. I could be misspeaking. I'll make sure in my footnotes below the video, if there's anything I'm wrong on, I'll clarify it. But reiterated a statement that China had made some years back, perhaps 2-3 years ago, which was that they didn't feel that the U.S. dollar should continue to be the global reserve currency or world reserve currency. In a nutshell, what happens is if you're in any foreign country and you want to buy most commodities, you have to pay for them in U.S. dollars. So virtually all of these other countries had to hold a portion of their money in U.S. dollars, which meant there's a lot of demand for dollars. So if we wanted to continue to borrow and borrow and borrow or print money, there always seemed to be someone willing to either buy our debt or to hold our dollars. And that's starting to change. And as that happens, it puts a lot of pressure on the United States, because we can't simply issue more and more debt. If we do and nobody shows up to the auctions, we'll have to start printing money like crazy. When we do that, it will create inflation. Some of the other things too that just sort of have reiterated the fear that people have. There was a report that came out showing that there's a large percentage of Americans that are right now on unemployment, and that unemployment is set to run out, and so that spending will stop. And if we look at some of the information, I think I showed some charts in one of the blog posts about the way that our debt has risen, and as well as the amount of personal debts, the debts of individuals in this country has risen in the past few years. And you can kind of see that, what's happening right now, to me, is a lot like what happened with the housing bubble just a few years ago. I remember in 2006 and 2007 sitting down with clients and talking about how that it didn't seem right. Why is it that these home prices keep going up? You drive through new developments, and you'd see these young families with two new SUVs out in the driveway in this great big house, and you kind of wondered how could they afford it. And we would say that kind of knowing the answer, which was they ultimately couldn't all afford it. Not everybody can afford to have that lifestyle that seemed to be very commonplace all throughout the country. And then on top of that, there was all these speculators. You'd see the TV shows about flipping houses and all these renovation projects creating all this equity. Again, when that happens, a bubble starts to form. Well, the same thing is happening right now with debt in the United States. This conversation about the debt and the debt bubble and how is this going to play out, most of us have been having this conversation for at least a few years. A lot of people have talked about buying gold, and they've talked about buying silver. You see these locations popping up all over the country in strip malls. We buy gold and cash for gold and things like that. So, we start to see all these signs that there's these bubbles forming, and it's hard to know sometimes exactly what they are and what to do about it. Now, as far as where the market goes from here, I've looked at some of the charts. Unfortunately, pretty much everything is broken down to the point where you can't really make any accurate short-term assessment on where the market will go. About the best case scenario, I think, for most investors is that at some point in the next week or two, and I'm sorry I can't be more precise than that, we'll see some type of a bounce of sorts. And the bounce is simply when the market's trajectory falls so fast that at some point investors will start to come back into the market. When they see that, a lot of what's driving the market down are short sellers. These are people who are trying to profit from a falling market. Well, as soon as a little bit of stabilization comes in, the short sellers have to cover their positions. They have to buy investments to lock in their gains that they made on the selling of stocks they didn't actually own. When you see that, a market will have some type of a retracement, and that retracement usually will be anywhere from 25 to 50% of the decline. If we're looking at where the market is now, it's down 20% roughly from its high. If it continues to drop, again, we'd expect 25 to 50% of that retracement. And at that point, it's hard to say where the market could go, but I can tell you that if anybody's thinking of selling right now, you're best off to wait just a little bit, sometime again I think in the next 2 weeks, and the market will come back up. When it does, when it hits some of those numbers, perhaps that's the time to take some of the risk off the table if you feel that this isn't a great time to be taking risk. In our case, for our clients anyway, we've been heavily in cash. Most of our clients know this and have asked me why this was, and we've been that way for 6 months. So we've been able to see that these problems were coming. Of course, we missed a lot of that last, maybe 10-15% of the market's upside. We didn't participate a lot in it. But we're also capturing very little of the market's downside. Looking today at a client account that's in sort of like our moderate, which is sort of our middle of the road portfolio, very common for our clients to have. In the past few weeks, we've dropped about 1/3 of what the total market has. So, I mean, in a nutshell, we're already conservative, already watching things, but we're not going to sell more at this point. I think what, again, will happen is we'll see some type of retracement. And when that happens, I would be shocked if we didn't actually sell some at that time. So, anyways, my little video update for today. I just want to make sure people know that we are watching this. I don't normally post every day, but I've posted pretty much every business day the last 6 or 7 days. And the real big reason is that I think that there's a lot of people that are scared. They're very fearful of a huge decline of 30, 40, 50%. I don't want to say that's out of the question. I actually think it's possible. I just don't think it will all happen at once. There'll be some type of a recovery attempt. The recovery attempt, I would say, is at this point not real likely to succeed and then go back into new highs for the year. There seems to be too much momentum against it, too many sort of outside influences stacked against the market's recovery. I do think our government will throw everything they can at it. Right now, there's sort of just a blame game, where you have the Geithner blaming S&P, and then you've got Obama, blaming the market's crash for gridlock in Congress. So eventually they'll start to take some action. I don't think that's the right solution because that's kind of what got us here in the first place. Again, just like the analogy that when you're overweight, you don't eat more food to lose weight. You need to actually cut some of that. And the same problems that are driving our economy where it is now need to be addressed. And unfortunately, that could make for a rather painful time for investors, something that we've been warning about really for the better part of the last 6 to 9 months. So that's it for today. I hope everybody has a good Monday. I'll probably check back in at least once or twice this week. And of course, if you have any questions or comments or anything that you want to make sure that I cover, be sure to use the comment box below this video on the website. You can jot in, if you don't want to put your name, just put anonymous or something like that, and then just write your question. I'll make sure I get back on that. And then also, if you think anybody would benefit from some of the posts and insight that I've been putting on the website, just make sure that there's icons that look like a little F for Facebook and a little T for Twitter. If you have accounts like that, you can just click those buttons and allow you to share this with those other folks, or you can always email it as well. So that's it for today. I'm going to add a few more things text-wise on the site. So I just want to share some statistics on maybe how severe other quick declines have been, and then kind of what happens to give you some perspective on what we're seeing. But for now, this is Jason Wink on August 8th, and I will talk to you all soon. Thank you.